So, if you're joining us today, chances are that you've reached a point where you're thinking not just about your own retirement, but also about how to help your family while you're still here and leave a meaningful legacy after you're gone. And you are in the right place. Our host today is someone who spent more than 35 years helping families and especially grandparents protect and grow their wealth with smart, tax savvy planning. James Lang is a CPA, an estate attorney, and a nationally recognized expert on Roth IRA conversions, retirement distributions, and holistic tax and estate planning strategies. Jim's retirement planning techniques have been featured in the Wall Street Journal 37 times. He's the author of 10 best-selling financial books, including Retire Secure, and he's a paid contributor to Forbes.com, where he's published more than 20 articles on the strategies that he'll be covering today. His work is endorsed by some of the country's top experts, including Charles Schwab, Burton Malkiel, Ed Slott, Larry Kotlikoff, and many others. But what sets Jim apart truly is his ability to take complex tax law and turn it into actionable strategies. He published the first peer-reviewed article on Roth IRAs in 1998, predicted the end of the Stretch IRA years before Congress passed the Secure Act, and recently implemented a strategy for his own family that, given reasonable assumptions, will save over 1.1 million in taxes over his daughter's lifetime. That strategy was featured in the Wall Street Journal this past December, and a detailed article that Jim authored was published last month on Forbes.com. Through his interrelated firms, including a CPA firm that is currently in the process of preparing more than 750 tax returns annually, and a registered investment advisory firm that helps manage and plan for nearly 1 billion in assets under management. Jim and our team have helped hundreds of families build personalized financial master plans. Today's session is packed with strategies that grandparents can use to spend more confidently, give more strategically, and leave a tax savvy legacy. And the best part is that you'll be able to apply and benefit from these strategies that you learned today, whether you decide to work with us or not. So please join me in welcoming Jim Lang.
Thank you. So, one of the things that's so exciting to me about Roth IRA conversions, and specifically Roth IRA conversions for grandparents, is what an enormous difference you can make for yourself and for your family by taking advantage of some of the strategies that we're going to be talking about today. So, let's start with some of the problems that we all have. Before we even get into, let's call it the solution. For most grandparents who have IRAs, as we age, the minimum required distribution on our IRAs, even if we don't need the money for our annual spending, continues to grow and grow, meaning we are prematurely paying income taxes. And then with the money that's left, we're paying income taxes on the earnings, the dividends, the interest, the capital gains on that money. In addition, for people who are growing their IRAs, and frankly, with the market the last 20 years, many of our IRAs are higher than they were even 20 years ago, even if we've been taking withdrawals. There will be a massive income tax due to well, the retires, it's called the Secure Retirement Act, of, and it just decimates the IRAs because you literally have to take all that, your heirs have to take that, subject to exception, have to take out all that money within 10 years of your death, which just is just totally miserable. So let's start with the potential solution, and a likely solution for many of these miserable problems of massive income taxation while we're alive, and even more massive income taxation after our death due to the Secure Act. So, a series of Roth IRA conversions, all right, typically not 1 year, is often by far the best strategic solution of something that we can control. And why the government gave us this opportunity to save so much money, and why there is such a big difference between, say, the people in this room who like to, let's say, have control over their finances, and the people who are hanging out at the mall who don't even think about this stuff, even with the same starting resources, is just measured in tens, hundreds, some a thousand, sometimes well over $1 million. And it is potentially the most important action that you can take to protect your family and yourself. That is a series of Roth IRA conversions. And the other thing is, unfortunately, so many people spend so much time on things that they cannot control. What can't we control? We can't control the market. All right. So many of my clients look at their statements and actually look at online to see what their balance is every day, um, without really a lot of any control, although occasionally they'll adjust their investments. But the Roth IRA conversion is something that you can control and is sometimes much more meaningful than a change in your investments. So today we're going to go over some of the core information, some of the concepts, and some of the things that you can do. And one of the things that we're going to do, which I would call a core concept, is something called the secret. And we're going to talk about purchasing power as the only reliable way to evaluate a Roth IRA conversion. And by the way, also evaluate your own portfolio and how much purchasing power you have. We're going to talk about the OBBBA, which is wonderful if you are interested in reducing your own taxes, particularly for IRA and retirement plan owners, of which I think most of you are. And then we're going to talk about the impact of the OBBBA with Roth IRA conversions. And by the way, it is a very good thing and creates, let's say, an opportunity for additional Roth IRA conversions at what might be a great time to make them. And we'll talk about reducing the tax drag, which is, let's call it money that is forever taxed versus taxed once and then never again. We're going to talk about some of the advanced techniques that we've been using, including, this is really cool. Well, it's not cool for you, it's cool for your heirs. Making a Roth IRA conversion of an inherited IRA after you're dead at the beneficiaries rate, not your rate. Something that most people don't even know, including experts, don't even know that you can do, but you can save sometimes a lot of money. We'll talk about what I call the grandparent advantage. And if we're going to be honest about it, most of us are not even going to spend any of our Roth IRA. That might be a little bit disappointing. Doesn't mean that we can't, doesn't mean that we won't enjoy a lot more purchasing power while we are alive. But it also means that we can just make an enormous difference for our children and grandchildren, and particularly if you have a child or grandchild with a disability, what an enormous difference you can make by doing a series of Roth IRA conversions. All right, let's start with the OBBBA, the one big beautiful bill, which basically said, so here's what happened in 2017. In 2017, we had the Tax Cut and Jobs Act, and basically the income tax rates were slashed. But in order for it not to balloon the deficit too much, they said, okay, these rates are going to be temporary. So in 2026, these rates are going to jump back up. So the way it looked before is the rates were high, then we were going to have this low rate, and then it was in 2026, it was going to come back up. Well, the OBBBA said, hey, wait, we're not going to come back up. We're going to keep them where they were at 2017. So we have an extension, if you will, and it's called permanent. It's hard for me to believe that we're going to keep these low tax rates forever, but they're called a permanent tax cut. And that is a great time to do a series of Roth IRA conversions. So again, I say permanent for now. Older and wealthier IRA owners and their families will just benefit enormously from the OBBBA, and whatever you think of it politically, for the people on this call, this is a great thing for your own personal financial interest. You can potentially lock in low tax rates, do these Roth IRA conversions when the tax rates are basically at historical lows. And it does create enormous opportunity for tax-free growth for yourself, for potentially your kids, and even potentially your grandkids. Um, in this window, which we're going to talk about, and it's not the first time we've had a window, but this window to make Roth IRA conversions is really going to be a powerful um, tool to enhance family wealth. One of the problems with the OBBBA is that it is making things enormously complicated. It is miserable. The CPAs in our office, people say, "Oh, aren't you guys happy with all these new tax changes? It's going to make things so much more miserable." Well, I was about to say miserable, complicated. No, it just makes it miserable. Now we have a bifurcated code. Some of the provisions are permanent, some of them have rolling sunsets, and there's very little predictability. And here's some of the other things that make planning so much more important. It used to be, let's say, tax brackets. People thought, oh, if they go in $1 into that tax bracket, then their taxes are going to go up by five or ten or $20,000 or some enormous amount just because they missed it for a dollar. And I always used to say, no, that's just the marginal tax bracket. So if you go, say, from the 22 to the 24% bracket and you're just like $1 over, all that means is that one extra dollar will be taxed at the 24% bracket, not at the 22% bracket. And people go, oh, Hugh, I thought that if it went up by $1, that it would have this a normal thing. But now that's back in. So now they have all these triggers where if you're $1 over, boom, you get murdered. And that just makes planning so much miserable because before, when we were doing Roth calculations and we were, let's say, trying to stay in an existing bracket and we went a couple dollars over, it wasn't that big a deal. But now it can potentially be a really big deal. So the CPAs hate it. They really do. Um, and then alternative minimum tax, which is really miserable, that's become more complicated too. And unfortunately, we have a lot of clients that have pretty sophisticated tax situations, even if they don't even know that they have sophisticated tax situations. But the alternative minimum tax is more complicated than ever. People talk about tax simplifications. Never has happened during my lifetime. I doubt it ever will. Maybe they can simplify a portion, but they always make up for it with additional complications. And unfortunately, it's so miserable that, sometimes we call a tax return prepared in the OBBBA era an autopsy because it already murdered you. So what we want to do, we don't want to be historians. We are historians. That's what tax preparation is. What we really want to do is be tax planners. And we want to know what your tax return is going to look like before the end of the year, and sometimes even years ahead, and make adjustments. And Roth IRA conversions are one wonderful way to do that. Unfortunately, again, more complicated than that ever. Okay, but before we get into the complications, let's just talk about some of the traditional, classic Roth concepts that for some reason, very few people understand. And one of the reasons why very few people understand it is because hardly anybody talks about it. I've been talking about it since 1998. and um, and it's very, very important. So what a Roth IRA conversion is you're taking a traditional IRA. By the way, when I say IRA, it could be a 401k, it could be a 403b, it could be a SEP, it could be a KEO. But what all these types of plans have in common is that they have not yet been subject to income tax. Someday, somebody's going to pay income tax on that. Well, what if you pay taxes on it now, which is the opposite of my old tagline, pay taxes later? And in return, you get income tax-free growth for the rest of your life, the rest of your spouse's life, and another 10 years on top of that. And if you have a child or grandchild with a disability, for the life expectancy of your child or your grandchild. There's a few other exceptions that I won't go into. No minimum required distributions for you. No required minimum distributions for your spouse. Your heirs will have a required minimum distribution on the inherited Roth IRA, but those minimum required distributions of the inherited Roth IRA, either 10 years for most beneficiaries or for their lives for a designated, eligible designated beneficiary, somebody with a disability. So potentially, I don't know, 50, 80 years of potential tax-free growth with a Roth IRA conversion, which will happen in our family. But here's the secret. Again, hardly anybody explains it. I've given this, let's say, some variation of this talk to thousands, hundreds of thousands of people. And the key is we're going to measure in purchasing power instead of total dollars. So what do I mean by that? All right, so let's just say I keep going back to $1 million because it's a nice, easy number to remember. Okay, I have $1 million in my IRA. All right. Can I go out and buy $1 million worth of stuff or services? No, because when I cash in my IRA, I'm going to have to pay income taxes. Without getting into the complications, let's uh, just go with 24%. So when I cash it in, I only have $760,000. I can't go out and buy $1 million worth of goods and services. I can cash it in, pay my $240,000 in tax. And again, I'm not going to quibble on that. So I don't have $1 million worth of purchasing power. I only have $760,000 of purchasing power. Can we all agree that it is more meaningful to measure in dollars that we can actually spend rather than total dollars? All right. By the way, if you could put a yes in the chat, um, you know, for I don't know, 30 years, I did all these workshops in person. I would be able to look people in the eye and see their facial expression or ask for people to raise their hand. But if you could put a Y in the chat, if it makes sense to you to measure in purchasing power, that is how much in good measured in how much goods and services can you go out and purchase? All right, so let's do an example. Let's assume that both you and I, we, we have $100,000. By the way, it could be $1 million, but let's just keep it simple. We each have $100,000 in a traditional IRA. We each have $24,000 in what I'll call after-tax dollars. That is money not in an IRA. So measured in total dollars, we have $124,000. All right. Well, how about if we measure that in purchasing power? $100,000 of an IRA, but if we have to pay the income taxes on $100,000, and it's conveniently $24,000, and we use the $24,000 that I conveniently have in our example to pay the taxes, our $124,000 total, consisting of $100,000 IRA and a $24,000 after tax, is $100,000 in purchasing power. So again, can everybody see how $124,000 total dollars is really worth only $100,000 today? Okay? Let's change that to Roth IRA conversion. All right, you and I each have $100,000 in our IRA. We each have $24,000 in total dollars, and we all agree that if you cash in that $100,000 IRA, it's going to trigger a $24,000 tax. We're going to use the $24,000 that we have outside the IRA to pay the tax, and we both have $100,000 in purchasing power, even though we have $124,000 total. And let's say that I do nothing. Okay. I'm not going to make a Roth IRA conversion. And let's say that you decide, yes, I'm going to make a $100,000 Roth conversion. So you fill out the appropriate paperwork or have an advisor fill out the appropriate paperwork. And basically, it's saying to the IRS, please change my IRA to a Roth IRA that is going to grow income tax free. And then, wherever the money is at Schwab or wherever it is, they're going to send you a 1099. It's going to say, please pay tax on an additional $100,000 worth of income. And you do that, you use your $24,000 of after-tax dollars to pay that tax. So what are you left with? You're left with $100,000 in a Roth IRA. All right, I didn't do anything. I have $124,000 total because I have $100,000 IRA and $24,000 outside the IRA. So let's see how much purchasing power each of us have. I still have $100,000 because when I cash in my IRA, I'm going to have to pay $24,000 of income taxes. Where you, on the other hand, if you cash in your Roth IRA, you don't have to pay any income taxes. So you're left with $100,000 of purchasing power. So guess what? When we make a Roth IRA conversion, we're not giving up any purchasing power. We're, using the same assumptions. We have identical purchasing power, whether we make a Roth or whether we don't make a Roth measured on day one of the conversion. And this is actually mission critical because so many of the writers, so many of the software, written by people who don't understand the concepts and people who frankly should know better. I don't want to rag too much on a lot of the people in the profession and people even teaching this stuff, and they're teaching the wrong stuff. You're getting the right stuff here. They're measuring in total dollars. Well, if you measure in total dollars, you're $24,000 worse off, aren't you? So what happens is if you're measuring in total dollars, all right, then Roth IRA conversions are terrible for seniors because it's going to take a lot of years for you to make up in the tax-free difference compared to the taxable difference, what you had to pay in taxes for the Roth conversion. But if you measure in total purchasing power, then what happens is you're starting at a break even and then you go better and better and better. So the conclusion becomes different, which is basically if you're measuring in total dollars, Roth conversions are probably not very good for grandparents. But if you're measuring in purchasing power, they're often wonderful for grandparents. And so many people, the experts, the software, the AI tools, they get all this wrong, and as a result, people follow this, they think they're being very clever, and they're actually making a big mistake because they're using the wrong measurement tool. And that is mission critical. And I kind of wanted to start with that because that is what so much of this is based on and what so many people get wrong. The other thing I'll mention about Roth IRA conversions is usually, in fact, I'd say probably eight or nine times out of 10, the solution is not do a big Roth conversion in 1 year. I'm not saying that we've never done that, but typically it is a series of conversions over a number of years. So that's kind of the conclusion that we often arrive at. Interestingly, it's sometimes not an even amount. And it also depends on what is going on in your life and your income and your situation. But it typically is not a one-time shot and you're done. It's typically a number of years where you're making a series of Roth IRA conversions. The other thing when you do this calculation, particularly for grandparents, is a lot of the analysis stops when you die. Well, guess what? That doesn't make sense because, frankly, I don't think there's one person on this call that's going to die broke. All right. And what is going to be the last dollar that you're going to spend? And I did a little bit of this earlier. But basically, the last dollar you're typically going to spend, subject to some small exceptions, is your Roth. All right. Well, if you don't spend your Roth and you die, then your heirs are going to get all this tax-free assets that has just grown, grown, grown because you didn't have to pay tax on it after you made the conversion. All right. So one of the mistakes that a lot of these calculators make is they end the analysis at your death when really they should be looking at it for the life of your child or the life of your grandchild, which then shows the enormous benefit of Roth IRAs and Roth IRA conversions. Um, and then people say, okay, Jim, if a lot of the software is wrong, what do you guys do? Interestingly enough, you would think, you know, whiz bang number crunching CPAs who've been doing this for, since 1998 would have this souped up software. And by the way, we look at it and we're constantly analyzing it. And we do have some pretty sophisticated software. But here's the big thing that I think is mission critical. Warren Buffett said, don't invest in anything that you don't understand. Don't do a Roth IRA calculator if you don't understand every single input and where they are getting their money. We demand transparency when we are doing Roth calculations. Now, in the old days, back in the late 90s and even the early 2000s, we didn't have any of this software. When I did the peer reviewed analysis, I used Excel. All right. But here's the thing about Excel. I knew where every single number was coming from. I understood every single calculation. Um, Even if I didn't make it, I could go back and trace it, and I could audit it. It had a great paper trail, and I and all the number crunching CPAs in our office, none of whom are young, we are old school. We like to see if well now it's digital, but we like to see a trail. How did you get that number? What assumptions did you use? And so much of the software doesn't have that these days. And I've looked at the software and said, okay, well maybe we don't know it, but if if it comes up with the same numbers that we come up with when we have this transparency, maybe I will trust it more, but we can't reproduce it. You know, we have a lot of very quantitative type folks, and they can actually reproduce the results that we get if they have either the right software or they take the right time, the amount of time that can do it. So getting the math right is critical, but having accountability, that's one of the issues with AI. It's a great tool. I love it myself, but a lot of times it's just wrong. And one of the things that I have on my AI is where did you get that information? And by the way, even sometimes that's wrong. Um, but anyway, I like to know where did the number, and that's the way all our number crunching CPAs are. Where did you get that number? What assumptions did you use? And here's the other thing that I'll just be straightforward about. You could have the best software in the world, but it's the skill and the judgment of the number cruncher who's putting that information in that is much more important than the tools that they are using. I would rather have Steve or Jen or Dom or Mike with crappy software than somebody that doesn't know what they're doing with good software. Um, these guys, if they had to, they could do it in Excel, um, which would be a lot more time consuming. But the software that we use is much more spreadsheet-like and more primitive than you would likely expect. And by the way, it's time consuming. Now, maybe someday there'll be something better, faster. We're always looking, but all the stuff that's better, that's quote better and faster doesn't have accountability. We don't know where the numbers are coming from. We won't use it. Okay, so but you kind of get the idea. A lot of this is math. It's a big math problem. So what assumptions you use, mission critical. Um, but you also have to understand the concept of purchasing power. Okay, before I go to mistakes, I will ask Erica whether we have any questions on the where we are up to now, which is because getting the purchasing power right is really mission critical.
Actually, yes, Jim, we have a lot of questions and we have some that are specifically about purchasing power. So I'm going to go to those first. But thank you everyone for putting questions in the chat and please continue to put them into the webinar Q&A as they come to you. Jim, this first question comes from Jim and he asks, oops, sorry, where was I? Oops, okay. Sorry, guys. Okay. So Jim asks, he says, I understand the concept of purchasing power, but what happens when tax rates change? If I convert at 24%, but my kids end up in a 34% bracket when they inherit, does the 1 day break even still hold, or does the math only work if the rates stay the same?
Well, the math that I'm talking about purchasing power on day one refers to you, all right? And in some of the examples that we have run, we are kind of assuming a steady income tax rate. If tax rates go up, or in this case, Jim is planning to die with his Roth IRA, leaving it to his kids who are in a higher tax bracket than he is, not even withstanding future income tax raises. The value of the Roth IRA conversion is going to go up substantially. Now, will it go up on day one? No. Will the projected benefit of the Roth IRA conversion be higher for somebody who will likely be in a higher income tax bracket? In this case, Jim's kids. And guess what? A lot of times people who thought that they themselves were going to be in a lower income tax bracket after they retired. But then what happened between Social Security and their minimum required distribution is a lot of them are in a higher tax bracket than they were when they were working, which means doing a Roth IRA conversion before they hit that higher tax bracket is even more valuable. So it's a little bit counterintuitive, but the point that I was trying to get home at was that you yourself, forgetting your kids, forgetting inheritance for the moment, you yourself break even on day one. And the benefits accrue as time goes on, even assuming a flat income tax rate. If rates are going to go up higher, then the benefits are even higher.
We do have one more specific to purchasing power question. One of the live room attendees asked, what about the loss of the potential market gains on the 24K that was used to pay the taxes on the Roth conversions?
All right. So, do you really think that I submitted these articles to these nitpicking CPAs? That's what peer review is. So, like if you have if you're a doctor and you have a new treatment for cancer or a new drug or a new medication, whatever it is, you have to go through these painstaking analysis with this, really tough guidelines for what constitutes a study. And then, then you submit it ultimately after you're done with the whole study to the peer reviewers, whether it's the New England Journal of Medicine or whatever it is. And you have all these nitpicking people really trying to tear your article apart to make sure that you have gone through it, thoughtfully, and that it survives the scrutiny of all these experts. Well, we have the same thing in the tax world, and it's a different organization, obviously, called the American Institute of CPAs. And if you want to get published in the Tax Advisor, which is a peer-reviewed journal, the AICPA is going to review the heck out of this article, and they're going to be looking for loopholes. And the other thing is, when you submit an article for peer review, you actually not only have to do the words, you actually have to submit all your spreadsheets so they can go over your spreadsheets. So do you think it's possible that I would have overlooked the growth of the money that was if you had not made the Roth conversion? No, that's pretty well for me. And for the reviewers, that's pretty basic. So the answer is no. I certainly have taken that into consideration. And by the way, if that investment does better, then you'll do even better because the Roth is going to be growing income tax free. Should we take one more, or is that it for that cue for the purchasing power?
That is it for the specific purchasing power. We do have questions about Roth conversions and optimizing Roth conversions, but would you prefer that I save those for after dive into that material a little bit more deeply?
How about if we split the difference, take one more, and then I'll move on.
Okay. Um, we have an attendee who said, I realized I had some after-tax money in an old 401k that I rolled over to a traditional IRA at retirement about 10 years ago. Should I use this after-tax money to pay for the taxes on a Roth conversion or use it for a backdoor Roth?
The answer to that is neither. We're actually going to be covering this. Oh no, I took this part out. Um, so what you have in that situation is, by the way, I tried to reduce the scope because I just didn't want to overwhelm people, but and that was one of the things I did cut out. And this is an issue of after-tax dollars inside an IRA or a 401k. Here's the short answer to that. You might have to jump through a few hoops. You can actually convert that money to a Roth for free. All right. So that money came about by one of a couple ways. One, when you were putting money in your 401k, they limited the amount that you were allowed to deduct, but since it was tax deferred and or it was matched, you put it in anyway. So you didn't get a tax break, but you had this money that came from an after-tax source, um, and that should be separately identified. That's one of the cardinal sins of not treating this money separately when it should be. But to make the long story short, you can convert that money for free. So I actually analyzed this in a book I wrote called The Roth Revolution, and we looked at a, a $50,000 after tax in the IRA or 401k, and we made a Roth conversion of it for free and looked at it 50 years later. We were $500,000 better off than if we had done nothing. Okay. So yes, you don't get rich quickly this way, but you do get rich slowly. Uh, I'll just say, and that was one of the things I was going to cover that I cut out. But a very, very cool strategy. I used to do a number of advanced techniques, and then I just realized I was overwhelming people. So good question, very cool. But the answer is neither, because you haven't got the right advice up to now. That money should have actually been converted to a Roth the day that you retired, depending on what year you retired. But anyway, most of the advisors don't get this right. It's nerdy CPAs that get this stuff right, not typically financial advisors. And the lawyers, well, I better watch myself. Okay, so let's talk about some of the common mistakes people make. First, doing nothing. All right, pretty common mistake. They just don't even think about Roth IRA conversions. Second, and then oh, there we go. They use the wrong software, which happens a lot. All right. Next is they guess and they don't really run the numbers. And it's math, so don't guess. Run the numbers or pay somebody to run the numbers. But it's, again, difference tens, hundreds, thousands of dollars. Our family is going to be millions of dollars better off because I made a Roth conversion in 1998. And maybe I have a lot of repeat listeners, so I saved the story of we had a fire in 1998. My income went way down. We had $250,000 at that time. We made a Roth conversion. That money, that $250,000 Roth conversion, we now have a balance of well over $2 million, and that's just at 8%. It wasn't because it was a brilliant investment. It's actually a little bit higher than 8% since then. And that money has grown tax-free since 1998. It will continue to grow tax-free for my and my wife's life because we will never spend a nickel of it. My wife would rather eat rice and beans than spend one nickel of our Roth, and that will ultimately go to our daughter who has a disability, which means that she will be able to stretch that inherited Roth IRA over her lifetime. So our family, because of that Roth conversion, will be millions of dollars better off. And the other thing that people do is they say, oh, okay, I'll go up to the top of my existing tax bracket, but I won't go beyond that. And that might be better than nothing, but it's by no means optimal. We often go well above the existing tax bracket, including the existing Medicare tax bracket, which we'll get to, particularly if we have a long-term view, which to me, since here, here's another thing. I think I cover this later on, but I'm thinking about it right now. You know, there hardly anybody ever spends their Roth. I've been involved in probably hundreds of millions, maybe billions of dollars of Roth conversions. I hardly know anybody who has spent it, or maybe they spend a little bit of it. Does that mean you shouldn't do it? No, because it's more money for you, more purchasing power for you. But since it's typically the last dollar that you spend, and most of you don't spend anywhere near what you could afford, which is one of the purposes of the first session to show you how much money you really could afford, is, and it's still a wonderful thing. All right. And we'll talk more. I was featured in 2019 in an article. You know, the idea is I'm riding my bike in the desert while my Roth IRA conversion just keeps on growing. And that's going to happen for the rest of my and my wife's life. And for a large extent, even my daughter, who is 30 years old and has a disability, that Roth and tax free is just going to keep rolling. And then the other thing is listening to the quote experts, and they're not really experts. You know, you want somebody who understands the concept of purchasing power, understand this is math, is not relying on software that they don't know where the numbers came from or they can't track the numbers. And that happens all the time. And you know, my guy said, or and I don't pay. I'll say, well, can I see their work papers? Well, they didn't really have any work. Well, can I see their they're no, you want people who know what they're doing in this area. And unfortunately, it's nowhere near as many people as you might think. And then here's one of my favorites. Oh, my situation is different. I'm different than everybody else. Oh, math doesn't apply to you. Gravity doesn't apply to you. Well, even if you have anti-gravity boots, just change the assumptions. Math still applies to you. Gravity still applies to you. If your situation is different, then just change the assumptions. Oh, Jim, my income's really low now. It's going to be really high. Or go the other way. My income's really high now. It's going to be really low. So therefore, the math doesn't apply to me. Of course, the math applies to you. Just change the assumptions. It's still math. These are these are math is math. Numbers are numbers. All right. And you can change the assumption. Oh, Jim, I think the market's going to tank. And I don't want to do anything because the market's going to tank. Oh, okay. How much do you think it's going to tank? Well, I think it's going to tank 10%. Oh, okay. Well, let's even take that into consideration. Let's assume that you're right and see whether it still makes sense to do a Roth IRA conversion. Or whatever your assumptions are, or whatever your situation is, or I'm going to inherit money, I'm going to make a big gift, I'm going to buy a house, I'm going to, all that stuff, it might have a huge impact on what you do, but that doesn't mean that you should give up math. And unfortunately, we have people who they think that they can abandon math because their situation is different. And my big thing is if your situation is different, great, change the assumptions and do the math. Or if you're not going to do it yourself, hire somebody to do the math. Because particularly for grandparents with $1 million in IRAs or retirement plans, Roth IRA conversions are likely the most powerful thing that you could do proactively that you have control over. You don't control the market, you never will. right? But you can control your Roth IRA conversion. You can control your estate planning, and you can control estate planning if you have a special needs grandchild or even child, in which case the Roth conversion, the value of a Roth conversion just goes way, way up when you do the math if you have a child or a grandchild who has a disability and is considered an eligible designated beneficiary. We're going to talk a little bit about that more in the estate planning section. All right, so let me just give you some of the results that we've done with comparing a series of Roth conversions versus doing nothing, measured in purchasing power, all right, and in inflation adjusted dollars. So again, it's real numbers. And it doesn't look like it's all that much over time. So here we have people who, and by the way, I'm not going to start like I did in 1998 in my 40s. We're going to start with somebody who's in their 60s now. And even within their lifetime or the life of their spouse, they're still better off by $270,000 measured in today's purchasing power. That's quite a bit. You had to work a long time to come up with $270,000 after taxes. But, and here's the real beauty of it, if you don't spend it, which most people won't, let's take a look at your kids, even assuming your kids have to take the money out in 10 years, which is the current law. The kids are better off in today's dollars, sometimes by $2 million over their lifetimes. And by the way, if one of your kids or grandkids has a disability, then the numbers saved go into multiple millions of the benefit of the Roth IRA conversion. And again, this is math. Not too many people would want to, but we don't make the math a secret. We're kind of an open book on that, and people can replicate just like the peer reviewers did back in 1998. And by the way, we're still writing articles on Roths all the time. Um, it's kind of like a farmer. If you were a farmer, and let's say you have two options. One, you say, okay, I'm willing to pay the income taxes on the seed that I buy. And in return, when I reap the harvest, it'll all be tax free. Or I'll take a deduction for the seed that I buy, but then when I reap the harvest, I have to pay tax on the whole harvest. Well, if you only have to pay tax on the seed, the way the math works is you're a lot better off. Okay. But by the way, I mentioned that I have a child with a disability, and I am working more and more in that area for parents. And now I'm very excited about this recent article that I did in Forbes.com, which is for grandparents of a child with a disability. Um, could I see by a show of hands, or maybe Erica, you have a little way of expressing it.
Yes, I do.
All right.
Jim had asked me beforehand just to prepare a quick survey. So before we move on to the next section, um, oops. Okay, before we move on to the next section of the presentation, Jim just asked me to take a quick uh, poll of the audience. So if you have a grandchild with a disability, would you type a Y into the chat now? The vast majority of the strategies that Jim is going to cover for the remainder of today's sessions apply to all grandparents and most retirees. But a couple of the more powerful techniques, including the one that we've been talking about all day, that they just applied and that is projected to save his daughter an additional 1.1 million in taxes over her lifetime, they involve specialized planning for families who have a grandchild with a disability. So us having the information as to how many of you here that applies to will really help him tailor his examples and make sure that he gives the strategies the time they deserve. So thank you, everyone. And I will tally those up and let you know, Jim.
Okay, thank you. All right, so the other thing that I wanted to mention before we go on to more substantive things is if you say, hey, these are some really good concepts, yeah, this would be a good team to work with. And we're going to do a longer description of our services at the end. But if you're already there and you go, yep, this is good stuff. I want to talk to Jim. I want to talk to his number crunching CPAs, see if they can help me, um, and whether they can more than cover their fee in terms of money saved for our family. Yes, I want to step in front of the line and request a consultation. And by the way, I will also tell you there's a reasonable chance that even if you request it, I'm not going to give it because we're at the age and stage we can be kind of picky about which clients we pick up. We certainly don't want a pain in the you know what. I just don't need it. But the other thing is, we like to really help people a lot. So we're going to be much more open, not just to the first people who sign up, although that's a factor, but much more open to giving consultations to people who we think can really help. One thing you don't have to worry about is requesting a consultation, us taking you as a client and not actually making it pay for you. A lot of times we choose clients on the basis of who we think we can help the most. And frankly, it's much more satisfying for both me and for the CPAs. I sometimes have CPAs say, hey, Jim, I really can't help these people that much. They're not a good candidate for Roths or estate plan. I'm the one who actually looks at the estate plan. I might say, hey, it doesn't happen often, by the way, but I might say, oh, the estate plan's pretty good, or all these minor tweak or things like that. That's not as exciting to me as, oh man, we can save this family hundreds of thousands of dollars, or we can really help these people out, or um, I wish they had come to us. In fact, what we get is, I wish I met you 10 or 20 years earlier. But anyway, if you are interested in this consultation and you want to go to the front of the line, please, um, and I would ask Justin to put up a link for that. Justin, if you could, to in effect ask for a retire secure consultation. Okay. And by the way, the consultation is not for drafting wills and trusts and beneficiary forms. It's really more the concepts for that will work into either assets under management or a financial master plan. Okay. Next question. When is the classic time to make a Roth conversion? All right, so let's say you're working, your income is up here. Then you're planning to retire, your income is going to go back here. Then, after Social Security and minimum required distribution comes back in, your income goes back up here. When's the ideal time to convert? Well, when your taxes are at the lowest point or the lowest tax rate. So that's the classic time to convert. Again, after retirement, before Social Security and required minimum distributions. Um, on the other hand, what we are finding is a lot of people who are already retired, it still makes sense for them to convert. Sometimes people who are still working, it makes sense for them to convert. I'm using this low tax bracket as an analogy because it makes sense, and um, it's a starting guideline, but it's not the end all and be all. And the current rate versus the future tax rate. It's important, but again, not the only factor. And here's the other thing that a lot of people overlook. Right now, let's assume that you are married and you are filing a joint tax return. Unfortunately, one of you will likely predecease the other. People talk about simultaneous death. That rarely happens. What is much more likely, if you're a married couple, is that one of you will die and then the survivor will survive for years. But here's the thing, the survivor will now, unless they remarry, which is a whole other different topic, but let's assume that they don't, they will be in a married, they went from married filing joint that had lower rates to a single taxpayer that has higher rates. So just by time passing and one of you dying, that alone will put the survivor in a much higher tax bracket. So one of the things I like to do is to do the conversions while you're both kicking because it's very predictable. One of you will predecease the other, and the survivor will be in the higher tax bracket. So even if you have a 20-year joint life expectancy, that doesn't mean that both of you are going to live 20 years. It means that one of you will, but let's get the conversions in while you're both kicking. Okay. In other words, do your conversions while you're both kicking. State of residence, that's a big factor. So many of my clients end up in states that they never thought that they would end up with. I just had one. She spent practically for 20 years telling me how much she hated Florida. Guess where she's living? Florida. Why is she living there? Because that's where her family went. So she's there. She hates Florida, but she loves living with her family. Um, Other clients, even real, I have some real, I tend to attract pretty smart clients. Two of the clients I'm thinking of, one of them, college professor, really bright. He loved my stuff. And when I used to do a lot of in-person events, he was kind of like the moderator, a little bit what Erica's doing right now. So he had heard me a bunch, smart guy, read all my books, all that kind of stuff. And he knew the worst thing that he could do for taxes is move from Pennsylvania that doesn't tax IRAs, doesn't tax Roth IRA conversions, and move to California that does tax IRA distributions, it does tax Roth conversions. Guess where he's living? California, because why? His family's there. I have other people, I have people who thought they would never move from Pennsylvania. They're living somewhere else. Where you are and where you're going to end up makes a big difference. And we like to, if you're going from, like, say, Pennsylvania to California, we want to do your conversion while you're in Pennsylvania. If you're in California moving to Pennsylvania, we want to do your conversion after you move. So that really does make a difference. Um, and the other thing that makes a difference is, well, what bracket is your kid in? Where is your kid going to live? Because that makes a difference. Um, and then a topic that's very cool, who gets what, is sometimes we leave Roth IRAs to the kid in the high bracket, and then we leave IRAs to the kid in the low bracket. And even though we aim for, assuming that that's what you want, equal treatment by having, we call it who gets what, we end up with a lot more money for your family and a lot less money for the IRS, which probably makes just about everybody happy. Again, if your kids are in a high bracket, a more Roth conversion, a more aggressive Roth conversion might very well be appropriate. And then again, who gets what? Very, very cool. I actually cut that out of the estate planning session because I just had too much to cover, but very, very cool idea. Uh, High income kids get Roth, low income kids get regular IRA. All right, the other thing, so many people who are number crunchers, they always talk about, oh, what about Medicare Part B? If I do a Roth conversion, that's going to, I not only have to take into consideration my marginal income tax bracket, I have to take into consideration the additional amount of money that I'm going to have to pay in premiums on Medicare Part B. So what they often end up doing is not converting as much because they don't want to get into that higher bracket for Medicare Part B. The people who are really famous for this are the Westinghouse retirees. So for many, many years, I've done an annual address to they're called the Shore Group, which is basically these smart old engineers. And a lot of those folks, they'd rather have a root canal than pay additional Medicare Part B. And even though they're pretty good number crunchers, what they sometimes don't take into account is that future required minimum distributions are reduced because the Roth IRA is higher, the traditional IRA is lower. That reduced future RMD then lowers the Medicare Part B premium. And in the long run, it's still good to do the conversion, even though they're bumping up their short term Medicare Part B. We actually have a whole chapter in that in the book. Well, it's called Retire Secure for professors and TIA participants, of which about 10% is for um, college professors and TIA participants. The vast majority of it is for everybody. Or I should say IRA owners. We have an extensive section, specifically a whole chapter on just this issue. You can look into that, but I'll just say that it is often overrated how important it is because people use too short a time horizon, and particularly for grandparents who are interested in providing for the next two generations, the Medicare Part B disadvantage it becomes less and less important because people stop analyzing at their own death when that's not really the most powerful feature of the Roth. Again, we do it sometimes over the life of the kids or even the life of the grandkids. And of course, I'm always going to say it's best to run the numbers in your own personal situation. All right, so we are at a good point to ask some questions because the next topic is a new topic. So, do we have any more questions up to date so far, Erica?
We have a lot of questions. Let me get dig into them to see which ones are most applicable to the specific topics that you've just covered. Um, so we have a lot of people asking about trade-offs with paying IRMAA on after having made Roth conversions versus paying IRMAA on RMDs. Actually, that's an interesting because that question there from Bill actually is encapsulating both sides of that equation a little bit. So, can you talk about the trade-offs between paying IRMAA after having increased IRMAA on your Medicare, is it Part B, after having made Roth conversions versus not doing that and then ending up paying more in IRMAA from your higher RMDs later in your retirement?
Well, again, I hate to just keep saying the same thing again and again, but you have to run the numbers. All right. And you also have to take into account what your family situation is. Um, so let's say that you have two people in their 70s and they don't have any kids, or they don't care about, well, I don't want to say they don't care about their kids, but let's just say, there are a number of people, they don't tend to come to me. The type of people, excuse me, uh, the type of people I tend to attract tend to be very family oriented, and they tend to be what we call family stewards. A family steward is somebody who sees either an obligation or a desire to do the right thing, not just for themselves, but for the next two generations. For those people, when you run the numbers, and particularly you take into account the benefits for the children and the grandchildren, the short term hit on the Medicare Part B tends to be not nearly as powerful as the benefits of the long term benefits for not only themselves, but for their children and grandchildren. If, on the other hand, you're saying, hey, you know, I worked my you know what off, I paid for their college, I paid for their dental bills, I did all this, there's something left over, great, but it's really about me. By the way, in that case, what are we doing? We're changing the assumptions, we're changing the goals. We're going to get a different conclusion than if somebody said, I'm very interested in protecting the wealth for the family. So it's one of those things that you have to run the numbers in terms of general concepts. The longer the time horizon, the more the Roth conversion will make sense, and the more the temporary blip in the taxes on the Medicare Part B is going to have an impact. And taking into consideration the prior question, I am taking into consideration the loss of the purchasing power that we would get if we're not paying the taxes. All right, why don't we take one more?
Great. And then this question actually is popping to the top of my brain because actually my mom just mentioned an element of this to me today. I think my dad must be doing their taxes right now. But Anil asked, for a senior taking required minimum distributions, does it make sense to do Roth conversions even if they lose the senior deduction because of Roth conversion?
By the way, this is a good example of a new tax nuance that is one of the things that are making our CPAs miserable. And I will say that that hurts a Roth conversion. On the other hand, that's not that's not what I would call big stuff. I don't get all that excited about saving a couple $1,000s. I get excited about saving tens or hundreds of thousands of dollars or even $1 million. So the senior deduction, I'm not going to say you shouldn't take that into consideration. I'll just say relative to the very big picture, that's probably small potatoes. Again, our my CPAs are they're more precise than I am. Um, but I would just say that that's not what gets me excited. What really, see, here's the thing about the Roth. You guys are never going to spend it. That's just the truth for 95% of you. Maybe you'll spend a little bit. Could you afford to spend more if you do a series of Roth conversions? Yes, but you're not going to die broke. And the asset that you're most likely to die with is going to be the Roth. So the Roth conversion becomes even more compelling, knowing that you not only have your life expectancy, your spouse's life expectancy, but an additional 10 years of tax-free growth and no minimum required distribution on that money. And it just compounds and compounds. And, I think it was Mark Twain who talked about, the wonders of tax deferral. Well, tax free is even better. So again, do we ignore the short-term things like the senior tax deduction, which by the way, if you've never heard of it, that just means that you're not keeping up with every little nuance, which frankly is just a pain in the you know what to the CPAs in our office. But the real benefit is this long-term benefit. Our family is going to be millions of dollars better off, and particularly if you have a child with or a grandchild with a disability, having those kinds of long-term benefits are enormous. Why don't we take one more and then we will move on?
Great. And now, Jim, I would like to just put in we had a comment from Jean, which I feel like is apt for me to throw in here, which is I think that you are very correct that most of the people in this webinar will not spend most of their Roth in their own lifetimes. But he pointed out that we're a little biased because of the class of clientele that we are dealing with, and that most of the general population, in fact, has not saved or prepared enough for retirement, which I've done a little bit of research on some of the statistics that are available on that in the last couple of years. And I have to say that I think that that's a pretty astute observation. But that being said, Jim's talking to the people in this room, and so I think that's totally fair. But I did think that was an important caveat, I guess, or a smart one to put in there. The next question actually
Well,
is
but
from.
by the way, let me just respond to that.
Mhm.
When I do my in-person workshops, I usually ask a bunch of questions and a lot of times ask people, whether they like to be in control and whether they care about their future and the future for their kids and their grandkids. And I ask by a show of hands who are, and practically everybody raises their hands. And my comment is, well, if that's a minority, where's everybody else? Well, they're not spending their afternoons listening to how they can protect their family. They're at the mall spending the money. It's a fair comment. Frankly, those folks tend to not read what I have to say. Um, and by the way, they would still be better off doing Roth conversions, even if the plan is for them to spend it.
Yes,
Uh,
but they would
they,
have trouble having the income in the period where they were making the conversions. I mean, that is true. That would be the problem for them. But
Well, if they don't have anything, then maybe not. But even if they have some after-tax dollars, and by the way, we do Roth conversions for people who you would think it doesn't make any sense. I'll give you an example. Let's say that your let's say that your parents, or maybe you're in this position. Let's say that you are going to enter into a retirement community, all right, or a nursing home. And a lot of times, these communities have a very large upfront cost, all right, maybe hundreds of thousands of dollars. And they don't even think about it. They pay it or they finance it or they do whatever they want. And they don't think, oh, well, gee, after that, my income's going to be kind of low because I'm not going to have as much dividends and interest, and I'm just going to have Social Security, and Roths don't really make sense. No, that's a fantastic time to make a Roth conversion. If you have, let's say, a $500,000 entry fee into some type of community, a lot of times that community will allocate a certain percentage, often a high percentage, as a medical expense. And then you do a big Roth conversion that same year, and you end up basically converting a lot of your IRA to a Roth without any tax consequences. And you might think, oh, okay, well, it's not going to be that big a deal because I'm not going to have a lot of big taxes after I'm gone. No, but your kids might and your grandkids might. So doing something like that could save hundreds of thousands of dollars for the family. And we have taken people who literally have like near zero income. They're not paying any taxes. And that's a great time to do Roth conversions because it's going to be great for the family. So just don't assume too much that you're not necessarily a candidate when, in fact, even if you're not the primary end beneficiary, you could still do a lot for your family.
And you actually, when you see the numbers yourself, because obviously when we're doing these conversions for clients, they are maybe walking into the room thinking, well, I'm a candidate for these strategies, but clearly not for Roths. And then they see the math and then they want to do it. But, they're not doing it against their will or anything. Actually, the next question or the last question I want to ask you right now ties into this question of taxation for you or for your kids and the best way to leave money. Kenneth asks, if we leave a traditional IRA to be inherited by our children, is it still true that the IRA cannot be rolled over into a Roth by them? Doing it before we die seems to be more beneficial.
Well, that's going to tie into one of the advanced strategies that we have. In fact, I'll tell you what, let's hold off on that one because I actually have a whole section on that exact question. The short answer is you can't make a Roth IRA conversion of an inherited IRA, but you can of an inherited Roth IRA, of an inherited 401k. And we have a cool strategy that has saved families hundreds of thousands of dollars doing just that. That's the short
Okay,
answer.
then can we
All right,
just do
one
one
more
short
since that
one?
was, yeah,
Yeah. Uh, an attendee asked, can an inherited IRA be converted to a Roth?
no,
Okay.
no. An inherited 401k under the right circumstances, if it's planned for, can, and we'll talk about that soon. Okay. Um, I am trying to get my clicker back, but well, I'll tell you what, I'm while Eric's working on that, I'll just go into this situation. All right. So let's say, for discussion's sake, you're in a high tax bracket and your kids are in a low tax bracket. And yes, it still might make sense to do a Roth conversion because the kids have this longer life expectancy, even if they have to pay the taxes in 10 years. But wouldn't it be cool if instead of you making a Roth conversion at your rate, which is higher than dying, and the kids save the money at a lower rate, wouldn't it be cool if your kids could make a Roth conversion of the inherited IRA? But I just said, kids, you're not allowed to make a Roth conversion of an inherited IRA. But here's one of the exceptions, a very cool loophole. Hardly anybody knows about it. We've done it quite a bit because it's fun and it's free. This doesn't cost you anything other than, well, it costs you some aggravation, a little bit of accounting, a little bit of legal. But you are allowed to make a conversion of an inherited 401k, but not an inherited IRA. And by the way, there's some limitations on that. So what we have been doing is we sometimes we start 401ks, and we often sometimes have to get some earned income. We get clients to set up their own one-person 401k. We go the opposite way. Most advisors are saying, get your money out of that 401k, put it into our IRA so we can charge you. Well, they don't say so we can charge you 1%, but that's the way that they try to um, let's say, move you is they away from the 401k to the IRA, there's a bunch of reasons why you might want to stay in the 401k, or if it's too late, and or if the 401k that you're already in doesn't have the provision that allows the heir to make the Roth conversion after you're gone, you might want to set up your own 401k. And by the way, that's going to be one of the limitations. It's not the IRS's limitation, it's the limitation of the 401k plan that you're in. And most 401k plans, they don't care about your heirs making a Roth conversion after you're done. So if we get involved and we have the ability, we're going to set up a 401k plan that does allow you to make an inherited Roth conversion after the death of the 401k owner. And I will just tell you that if you're converting at 10 or 12%, that and you do it over a series of years, that is much, much better than converting at, say, 30, 32% or whatever the bracket is. Hardly anybody knows about it. A lot of times it doesn't work in practice because of some limitations, or some people don't want the complications. And if I'm only going to save 5 or 10 or even $20,000, I'm probably not going to do it. If I save $100,000, $200,000, then it becomes more interesting to me. And again, you can't do it with a traditional IRA, only with a 401k. Hardly anybody knows about. Okay. And the advantage is you're converting at your kids' bracket, potentially your grandkids, not your bracket. And again, the IRS allows it, but your plan custodian might not. So if you have a 401k from particularly a large company, there's a very good chance that they are not going to allow you to do that, which means you have to transfer it to your own 401k, assuming that you can do that. And again, most custodians, you ask them, they've never even heard of this, which is frustrating for us and frustrating for you. But frankly, that's one of the ideas of getting people who can add value, because they know some things that a lot of people don't know. Okay, some other advanced techniques. All right, and this isn't really even Roth conversion, but it's the same concept of Roth conversion. So let's say, for discussion's sake, that you're very next generation, next 2 generations oriented. And let's say you're at a high bracket, or let's say for a number of reasons, additional Roth conversions don't make sense for you. Here's what you could do. You could cash in a part of your IRA, maybe up to a certain bracket, or we calculate it. Pay the tax, you end up with after-tax dollars because reduced because you had to pay some taxes. Then you gift it to a child or a grandchild and have them invest in something that is tax-free. All right. And examples would be a 529 plan, grows tax-free. Another example is life insurance, grows tax-free. Another example is your kids or your grandkids' Roth IRA, Roth 401k, or even here's some money for a Roth conversion. So you're still getting tax-free growth, most likely for, particularly for your kids and grandkids, Roth IRAs and Roth conversions, many more years than you will be around. And this often ends up being a great strategy, even though it's not exactly a Roth IRA conversion for you. So we have done this quite a bit. And sometimes the long-term wealth accumulation, particularly for the people who've been with me since 98, some of the stuff that we have done. And what happens is this stuff actually happens. So when my wife and I made that $250,000 Roth conversion in 1998, now we see it at 2.2, not to even add in the additional Roth conversions and contributions we've made. Life goes on. The Roth keeps growing. It's wonderful. And frankly, some people are on top of it, some people are not. We are, and it is a wonderful thing particularly for people who are interested in long-term accumulation for their family. Oh, the other thing, health savings accounts. Funding your kids or your grandkids' health savings accounts, they're wonderful. Health savings accounts, by the way, they're better than Roth. If you're still working, or your kid, or you could tell this to your kids, with a health state, I'll tell you why a health savings is better than a Roth. Because with a health savings, you get a tax deduction, and assuming the eventual distribution is going out for medical, you get a tax-free distribution. So you got a tax deduction going in, which you don't get with a Roth, and then tax-free distribution, including the growth, as long as you take it out for medical. And if you live long enough, believe me, you're going to have some medical. If nothing else, medical insurance premiums. So health savings accounts are wonderful, better than Roths. Um, and some of these strategies, you're basically going from the taxable world to the tax-free world for many, many more years than your likely life expectancy. And again, the other thing is it does grow outside your estate, and it's one of the very, very powerful techniques that grandparents can use while reducing your own taxable income. I'm sorry, your own taxable estate. So in 2019, Forbes, the big Forbes, not Forbes.com, which is what I'll call little Forbes, but the big Forbes.com, we were actually on the cover, um, ran an article on Roth IRA conversions. And I was the main quoted expert by an article by Ashley Ebling, who, by the way, she's now with the Wall Street Journal, and I've collaborated with her on actually with for children with a or grandparents with a child with a disability. Very, very smart, running the numbers type uh, journalist. But anyway, she did a whole story. It was a big, long story, and we did all the numbers. But she did a lot of great work, and basically it was this is the time and place to do a Roth IRA conversion. I was the leading expert. And interestingly, there's some commonalities between 2019 and now in terms of Roth IRA conversions. So, example, 2019, it was after the Tax Cut and Jobs Act of 2017 when taxes were low, but they were expected to go back up. Okay. Well, now, guess what? Instead of the taxes going back up, they're still low. Now, theoretically, these low taxes are permanent, but who's kidding whom? We have a $39 trillion deficit. Who's going to pay for all this? Ultimately, it's going to be us. Someday, somebody sane is going to say, "Hey, we just can't." And they've always been unsuccessful at cutting costs. Um, so if we are at a low point, and we are historically, by the way, at a low point in terms of our tax rate, if you look at some of the old tax rates, the benefits of the Roth are much greater if the tax rates go up. The market was down back then. Well, who knows what's going on, but with the market, and I don't want to try to predict, but we have a lot of volatility right now. Iran, we have the tariffs, we have the oil prices, we have the AI. Maybe this is a good time to do a Roth, although again, I don't want to be a timer. So, and by the way, that article featured that Cindy and I converted, I say $250,000 because I round off, but we actually converted $239,000 to a Roth. And by the way, my wife is she's not a CPA, but she has a number crunching. She has a master's degree in electrical engineering from Carnegie Mellon. And when I suggested that we convert all our traditional retirement plans, which back in 1998 totaled 239,000 to a Roth, she did not want to write that check for the Roth conversion. And then we went through the math. Again, that was back then, it was on an Excel spreadsheet. And I, convinced her. And now, well, at the time of the article, that Roth was 1.25 million. Today, it's more than $2 million in a Roth. And since our plan is to die with it, it will continue growing, hopefully another 20, 30 years or maybe longer for our lifetime. And our daughter, who is 30 and has a disability, she can stretch that inherited Roth IRA for her lifetime. We would just be so much better off because we paid the tax on that $239,000 back in 1998. Um, all right. So, Erica, before I go into this one, were there a number of people who have grandchildren with a disability when we asked that question?
Of the total attendee percentage, it was about 15.
Okay. I'm not going to take a lot of time on that, but here's what I will say. For grandparents, doing a Roth conversion, again, can be great. You're never going to spend your Roth. Tax-free reservoir for your kids and your grandkids. And the combination of low rates and market volatility does make this a great time. But if you are going to leave that to a child or a grandchild with a disability, and they can stretch that inherited Roth over their lifetime, it can just make an enormous difference. And by the way, what the Forbes article did, and we'll cover this a little bit more in the estate planning section, is I actually had my father-in-law, who, to oversimplify, had $1 million in his IRA, who he was going to split 50-50 with his kids. And instead of that $500,000 IRA going to my wife, which was the natural course of things, I had suggested to him, why don't you let my wife disclaim that so she still has the choice into a special needs trust for the benefit of our daughter. And our daughter, just that, and this isn't Roth, by the way, she actually she will be $1 million better off over her lifetime. So there's just some amazing things that you can do. But by the way, there's a lot of things, most of the stuff that you can do, you don't need to have a child or grandchild with a disability. But I'll just say that some of the opportunities of tax savings, if you have a child or a grandchild with a disability, is enormous. And one of the reasons why I instantly understood it was because before the Secure Act hit in 2000, everybody was able to stretch the inherited IRA over their lifetime. So that's how I grew up, and let's say that was my early Roth thinking, is that we could stretch this. And we used to have disclaimers going to grandkids, and the grandkids used to stretch it. Now we're limited. We still can for a kid with a disability, but maybe a grandkid's in a lower tax bracket than a kid. Anyway, just some wonderful things. By the way, a couple quick case study where we compared doing, let's say, a lot of these case studies are, this guy's a genius, that's us. This guy's a moron, that's everybody else. And look how much better off the genius is than the moron. Well, okay, so what we did is we said, okay, let's assume that we're not going to assume the best strategy versus the worst strategy. We'll say the best strategy versus a pretty good strategy, but not the best strategy. I'm not going to go through all the assumptions, but they are there for the people who like it. So we're not going to hold the best strategies, holding off for the higher earner to wait until 70 to take Social Security, but it's not unreasonable to take it at 67. All right. It's reasonable to contribute money to a 401k, but maybe not a Roth 401k. It's reasonable at a certain point to stop making Roth conversions, but it might be better to keep making Roth conversions. So then we took a look at, let's call it reasonable versus what we thought was optimal, which was 7 years of Roth conversion. By the way, interestingly, some years 50,000, some years 100,000, some years 200,000. And over the kid's life, it was over $3 million difference. So the difference is just enormous of what you can potentially do. So Erica, why don't we take a few more questions before we go into the next topic?
Sounds great. And we do have a lot of really good questions. So this has been such a comprehensive session. I'm not sure exactly what topics to begin with, but we had, let's see, um, Elaine asked, what do the benefits of a Roth conversion look like for a couple without kids or grandkids?
I would say they are good, but not as good. Because if you don't have kids or grandkids, you have a shorter investment expectancy of tax-free growth. So let's say for discussion's sake that you're 60 years old and you think you have a 30-year life expectancy. And if you make a Roth conversion, you're going to have benefits for 30 years. Okay. And let's say, and I'm assuming that you don't care all that much. Maybe you have nieces and nephews that you care a lot about. But let's say that you're not all that worried about what's going to happen after you're both gone. Will you still have more purchasing power? Yes. Will we, if we ran the numbers, and let's say that we had we had a whole list of your assets, tax returned, everything else. Then we had somebody else and they were identical. Would we likely come up with two who did have kids and grandkids, and they did care about their kids and their grandkids after they were gone? Would we come up with two different recommendations? The answer is absolutely yes. Would we likely still make Roth conversion recommendations for you without regard to what happens after you're both gone? And the answer is yes. Would we likely make bigger ones for people who don't have, who are interested in the next two generations? The answer is yes. And if you have a kid or a grandkid with a disability, would it even be better? Then the answer again is yes.
And this next question comes from Steven. He says, if my heirs convert my 401k to a Roth after I die, do they still have to distribute it within 10 years under the Secure Act, or does converting it to a Roth change the distribution timeline?
Still has to come out in 10 years. Good try, though. He has what I had a law professor, he used to call it larceny of the heart. They're trying to squeeze the last drop out of the tax code. I
And you very
certainly,
much appreciate that, right?
I do appreciate that, and I like that. In this case, though, good try, but the answer is no. Well, that was a
We,
quick one. Why don't we take one or two more?
we actually had another one about the 401k conversion. You mentioned, sorry, Andrew asks, you mentioned setting up your own 401k as a workaround for custodians who won't allow this. Is that something any retiree can do, or do you need to have some kind of business income? Is there a minimum amount that it makes sense and it's worth the hassle of setting up a separate plan?
Well, a good question on a couple things. First, is it worth the hassle? People like simplicity, okay? I don't like to complicate life for 5 or 10,000 bucks. I just won't recommend it. Even at 100,000, people really like simplicity. But if I start seeing real money, and this, by the way, it's who's kidding whom, it's a little bit more complicated. If I see real money, I'm willing to enter into some complications for a lot of money. I'm even willing to go even more complications for even more money. This isn't a real simple technique. Nobody's heard of it. You sometimes get grief from the custodian and blah blah blah. Is it worth it for 5 or 10,000? No. For 100,000, you're getting closer. More than 100,000, then that becomes, much more exciting. The other problem with a 401k is if you are actually retired, okay, and you have a IRA money, all right, and you want to set up your own 401k, you actually have to have some earned income. So we've actually created, I don't want to say you want to be legitimate about this, um, but whether you do a little bit of consulting and the amount of income isn't important. You can have $10,000 worth of income, set up a one-person 401k plan, and transfer even more money from, let's say, your old 401k into the new 401k and do this maneuver for maybe $1 million, who knows? In which case, excuse me, it becomes very worthwhile. But I'm not a big fan of creating complications to save a little bit of money. People tend to like to keep things simple, but if you can save enough, I'm ready to go into some complications. And by the way, I will tell you that this disclaimer that's going to save our family $1 million. And by the way, that's measured in today's dollars, not future dollars. It was a pain in the you know what. And I didn't realize how big of a pain it was until after my father-in-law died. And all these bankers, they didn't know what they were doing. And we had to just watch over them like hawks because they would have, in several instances, they would have botched the whole strategy. So would I have done that, for example, even for $100,000 IRA? And the answer is no, I wouldn't have. Um, and now I don't even know if I'd do it for a 200,000 because it was aggravation. And it was worse because it was me and my wife's aggravation. It wasn't my clients or my employees' aggravation. That's not nice. Why don't we take one more question and then we'll move
Great. So Khalil asked, why is it a mistake only to convert up to the top of your current tax bracket?
Well, I'll just give you a hint or I'll give you an example. A lot of people, I'll give you the easy one. Oh, I'm in the 22% bracket. I never want to convert one nickel more than to go into the 24% bracket. Well, sometimes that additional amount that you convert that might be taxed to 24 instead of 22 in the short run, that can end up saving tens, hundreds of thousands of dollars down the road where the extra 2% in the big scheme of things or the long-term view becomes relatively immune because for two things. One, you might eventually be in the 24% bracket because your minimum required distribution just keeps going up and up and up for the money that you don't convert. And two, if your time horizon is long enough, then you can afford to convert at a higher rate. And particularly, by the way, if you have a grandchild with a disability, boy, you could probably go, much higher than that in terms of having there, that example that I started at the beginning, we broke even at day one. Well, if you can start at the 22 and it pushes you to the 24, you're not breaking even at day one, but maybe you're doing so much better over time that it becomes very worthwhile. And that becomes very apparent when you actually start getting into running the numbers, which is why the rule of thumb of convert to the top of your existing tax bracket is often maybe better than nothing, but nowhere near optimal. All right, why don't we take one more and then we'll move on.
Okay, catching me off guard.
Sorry about
Let me
that.
find.
I was just in the middle to do one more.
No, I know. Um, Let me find another good one. Let's see. We have some that I had been reserving because they are disability specific, and I thought that they might be. I think one of them, one of the attendees even said, like, this is a question for next session. But I actually think you may have already kind of addressed this with your analysis on the how beneficial Roth conversions are for different groups of people with like different circumstances and goals. But Charlton asked, is it better for me to do a Roth conversion during retirement or to leave it to my daughter's special needs trust to do the Roth conversion?
Well, with the exception of the 401k exception, which might be hard, your daughter can't make a Roth conversion after you're gone. But if you have a special needs child, and for our definition of a special needs child, we're talking about somebody who technically qualifies as an EDB, eligible designated beneficiary. The easy way of determining that is if the child is collecting or has already qualified to collect SSI or SSDI. Interestingly, the area that I'm fantastically excited about is there's a whole category of kids and grandkids with a disability who don't qualify for SSI or SSDI, but they do qualify for this ability to stretch the inherited IRA or the inherited Roth IRA over their lifetime. And this is going to be a huge area because so many people with a disability aren't qualifying for SSI or SSDI. So, I have clients who their kid is they're able to keep a job bagging groceries at the grocery store, but that makes them ineligible for SSI or SSDI, but they will be eligible to get the inherited stretch IRA. Or kids that maybe they are on the spectrum of autism, they have certain abilities, but maybe there's a couple things, there's maybe 2 out of 6 functions that they can't perform. So it's a whole new area. Hardly anybody knows about it. We actually wrote an article, but before we submitted it, we wanted to get some expert people to check it, and we couldn't find anybody. Eric, I know you're actually working on that itself. So I'll just say that there's some tremendous opportunity for parents or grandparents of a child with a disability, and we're going to use a broader definition of disability, not just kids who are or adults who are collecting SSI or SSDI, like my daughter, um, but people who are, let's say, more functional, may be able to hold at least a part-time job, or for whatever reason they were denied SSI or SSDI, but they will qualify. And by the way, you don't even need a doctor to sign off on that. You can have a psychologist, a social worker, and there's a number of other people. Very, very cool strategy, brand new. Don't want to go too far into it because, again, only 15% of you said that you have a child or a grandchild with a disability. Okay, I think I am ready to move on. And you might be thinking to yourself, okay, Jim, you had some pretty cool information. Um, you know, what is the next step? And I'll be very straightforward with you. Um, if you are up for it, do some of these calculations yourself. Again, I have clients that would rather have a root canal than pay an advisor a nickel, and I respect that. And if you are one of those people, I genuinely hope that you got a lot out of today's session. I also genuinely hope that you take advantage of the free resources, which are really significant, by the way, uh, enormous. Um, but I will tell you, particularly if you have a history of not paying a lot of attention to this, if you have a history of not making significant gifts to your kids, if you have a history that you and your wills are not really optimized, or you think that you're okay, but maybe you really probably should at least see. And we're going to be straightforward with you. If you're well set up, we'll tell you that. In fact, you might not even get a consultation because I might not think that I'm going to be able to help you that much. And I'm not in the business of charging fees to people who aren't going to benefit enormously. It's one of the nice things about being at the ages stage where I am. I just don't need that. In fact, I think Jen told me that everybody's busy at least till October, and that they'll work overtime to work for new clients that they think that they could help. But it's not like we're sitting around with nothing to do. And again, you could figure it out or put our team to work for you. Um, After reviewing your information, we will see who are good candidates that we can really benefit from. And then you will have we call it a retire secure consultation with me, either me and Jen or Dawn and let's call it our intern, who's only been doing in the tax world for 20 years. But in our world, you need several years of specialized training to do the kind of number crunching that our CPAs do. And that is the first step towards working with us. During our meet, and we ask you to fill out a lot of stuff. We ask for a questionnaire. I actually read your wills, maybe not every provision, but I actually review your wills, your beneficiary designations of your IRAs and retirement plans, your tax return, your lists of assets, your family setup. I do that myself, believe it or not. I don't know how long I'll keep doing that, but at this point, I'm still really into it, which is why I'm doing this. And to me, it's fun. I play chess and bridge, so this is even more fun because it's real money. But anyway, I ask a lot of questions. Um, and afterwards, we come up with one heck of a memo. It's really valuable. It has all kinds of information about estate planning and tax planning and Roth conversions and your family. Roth and Jen and Dawn, they do a bunch of work preparing for our consultation. And particularly if the consultation um, is after April 15th, they actually put in a whole bunch of time. And by the way, even if you ask, you're probably not likely to have that consultation before April 15th anyway, because of not just there, but my schedule also. And Roth, this session has been Roth. The last session was Roth conversion. The next session is estate planning. We're looking at all this and plenty more. And if you're interested, I'll just tell you very quickly why we think we have the best assets under management program there is, because assuming that you survive us and we want to work with you and you want to work with us, you work with one of our affiliated money managers who are data driven, academic, provide excellent service, low cost, either index or index like type funds, which is, by the way, where all my wife's money is. They employ what we think are the best asset allocation and asset location. People ignore that. Your Roth IRA should not be invested like your IRA. It should not be invested like your after tax dollars. And they will have an effect different portfolios based on the type of assets that is. And all that is very important, but it's not work that I want to do. So rather than me trying to be mediocre at it, I would rather have the experts do that. We do our part. And that way you get the best of both, which is our strategies, our number crunching, our what we call financial master plans. And you get a money manager all for the fee of a money manager, which is starts at 1% and then goes down over $1 million. So to me, you're getting this wonderful, what I think is serious tax savings and common sense and estate planning, et cetera, et cetera. And you get a great money manager all for the same amount. We do have a fee for service plan. Right now, we have a lengthy waiting list. I don't know if we're going to get to new ones or not. The earliest that we could even think about is the fourth quarter. But that is a possibility. We are the CPAs, they like the continuity. They like seeing the same people every year. They like it's more personal. That's what we have been doing for years. And what happens is, over time as you become friends, you care about people, and it's a more satisfying for us. And Jen and Dawn both like assets under management more because they like that continuity. Um, but we will find time for assets under management clients. They'll say that they'll work evenings, weekends, etc. That includes this financial master plan. Typically more than one review per year with a money manager, but at least and again, a whole bunch of work the first year, but even every year. Jen, who's really smart and she's really efficient, she's taking 6 hours to do these reviews per year. A couple hours to prepare, a couple hours to meet, uh, and then a couple hours for the conclusion and a report that we do. I don't know anybody that is providing this level of service and work and value for assets under management. I'll be right in the digital eye and I will tell you that. And again, the money is invested the same way that my money is invested, which is basically low cost index type. They're technically not an index fund. The closest thing, though, to the investment is Vanguard. So we're not trying to actively manage money. Of course, we are fiduciaries. And if you're a good candidate to work with us, what we would encourage you to do is to click the link in the chat box. Justin, I'll ask you to put that link up. And Justin will also be the person who is the scheduler, does a wonderful job with that. And people get to know him after a while because there's typically some back and forth. So Justin, if you could put that up, and our office will try to come up with a convenient time. If you are Western Pennsylvanian or you are willing to travel, I will be back in Pittsburgh in mid-May. Before that, it's all going to be Zoom. After that, if you're a local or willing to travel, it could be in person, or more likely, we used to have mainly a local practice. Now it's gone national, and it's from all over the country. So it will most likely be a Zoom meeting. I will tell you, I've done thousands of these consultations. I've been in business over 40 years, and no one has said or even implied that it wasn't worth their time. And that was back when people were flying in, driving hundreds of miles, let alone getting on a Zoom call. We often identify areas that can potentially save hundreds of thousands of dollars. And if I don't think that you're a good candidate, I'll tell you that too. So I'm not allowed to promise investments. Obviously, I shouldn't be. I don't have to tell you that. But here is what I am allowed to promise you, is that our CPAs do work really hard. All right. And they care and they spend a lot of time on these reviews. We are true fiduciaries. By the way, if I tell people to gift and to make Roth conversions, guess what? We make less money. After a meeting, Jen just said, you just knocked down our income by $10,000 a year. And which was accurate, but I did the right thing and I didn't even think twice about it. And I'll continue to do the right thing, which, by the way, in the long run, I think I'm going to actually get more business from it because we have a really good retention rate and get lots of referrals. So that's all good. If you are interested, take action.